Okay, so it's time to introduce iron condors and iron butterflies. What is the idea? The idea is to be short sellers, fixing in advance the maximum potential risk if we are very wrong in our analysis. An iron condor can be seen as a combination of other strategies, and you can use different combinations in order to achieve the same result. Indeed, the options used are the same, but what changes is how do you, let's say, you read the strategy. Indeed, one way to get to an iron condor could be the combination of a short straddle, could be the combination of a short strangle and a long strangle with the strike prices farther than the ones of the short strangle. Or another way would be to see the iron condor as the combination of two vertical spreads, short call vertical spread and a long put vertical spread. What am I talking about? Let's start with some considerations. Just to say, let's assume that, let's take the stock, let's stay on Apple. Okay, here we go. This is Apple. The trend is absolutely going up. So what we could expect is that the price will keep going up and up and up to the stars. So we could say I think that the price would very reasonably cross, I don't know, $275 within today and January the 17th. So let me purchase a call, strike to 275. I don't want to take the risk of being a short seller of option. So let's buy them, take a maximum potential risk, and take the chance to gain a lot of money if the price goes up like a rocket. Okay, so let's go to the chain of Apple. Let's take the maturity January the 17th, and let's take not just 4 strikes, but let's say up to 2 standard deviations. Okay, so the call 275 would cost 580. Okay, so this could be the idea. Let me close the Visual Basic, which is not useful. Okay, let's first just do the long call. Stocks USA call long 275 for $580. Close the strategy. So here we go. Long call, maximum potential loss $580. Maximum potential profit, the moon, the stars, no matter, no limits. Okay. So the idea is, okay, I expect a strong movement up in the underlying, but probabilities, historical probabilities tell me that, okay, it could happen that the price goes up, but the odds to have a very strong directional movement are so low that I could say, why not taking the chance of reducing, at least reducing the maximum potential loss, keeping at least a significant part of the potential profit if I am right and the underlying increases a lot. How could we keep most of the potential profit, reducing the maximum potential loss if I am wrong in my analysis? I could introduce another call, this time short, with a higher strike price, let's say 290, just to say. Let's go see the price. The 290 this time would be short, so $1.40. I would collect $1.40. Okay, let's do it. Let's create a new strategy. We are purchasing the call 275 for 5.8 each, but we are also adding a short call, strike 290 for 1.40. Close the strategy. And here we go. This is a bull call vertical spread. What you expect is that the price will increase, but you know that the price very hardly will go up like a rocket because it doesn't happen very often. So what you decide to do is to reduce your maximum potential loss, not $580 anymore, just $440. But what happens is that since you have a long call combined with a short call and they have the same multiplier, for any dollar over 290, what you gain on the long call 275 will be perfectly neutralized by $1 lost on the short call 290. So the payoff will be an horizontal line from 290 and up and up and up. So this is a bull call vertical spread. The expectation is the price will increase. What if we invert this payoff? Inverting the sign of the two options with short sell the call 275, we purchase the call 290. Why is that? Because odds are in favor of the short seller and against the buyer. But we already know that if you short sell a call and you're wrong, the more you're wrong, the more you will lose. So purchasing a call strike 290 will limit at a prefixed, already known in advance value, the maximum potential loss. Let's do this. In this case, the prices will not be the same because on purchasing we hit the ask price. On selling, we hit the bid. Here we do the opposite. On short selling, we hit 535. On purchasing, we hit 155. So 795, 535, 155. Okay, so let's do it. Let's reverse the trade, create a new strategy. Call long 290 for 155. Call short 275 for 535. Close your strategy. Here we go. This is a bear call vertical spread. What you hope is that the underlying will not go up. When you do a long bull call vertical spread, you hope that the price will increase. If you invert the trade, you short sell a call, you purchase a call with a higher strike price in order to buy a protection, low cost protection, to defend yourself from the risk of a significant tail event. You are doing a bear call vertical spread, assuming that the price will not increase. At least it will not increase too much. Okay. Here you have a maximum expected profit, $380. A maximum potential loss, 1,120, and that's just it. Because if the price goes up like a rocket, for every dollar you lose on the short sold call, it's perfectly balanced by each dollar you gain from the long 290 call. So the global payoff is an horizontal line set at minus 1,120 US dollars. Once again, it's all a matter of odds, because one could say, okay, why should I take a maximum potential profit of 380 and a maximum potential loss of 1,120, about 3 times and something, more or less? The answer is probabilities. How much probabilities are in your favor and how much probabilities are against you. So this is a short strategy, more or less, and it's a bear call vertical spread. The idea is I expect that 275 is a strong resistance for the price. So even if the price goes up, it will not cross it. It will be pushed back down at that level, even if it reaches that level. If I am wrong, maybe that the price will keep going up like a rocket, so I have to cover myself, to hedge myself from the risk of being very wrong, and in order to do that, I purchase a protection. That's it. This is a parachute, let's call it this way. And this could be seen as the right wing of a short strangle, Okay, remember the short strangle is something like this, up, stable, down. So this could be the right wing of a short strangle, and to the right wing of the short strangle, we add an horizontal wing by purchasing a call with a higher strike price. Could we do the same the other side? Here we would have a short put. Okay, if we wanted to do a short strangle, we would do short put, short call, and that's it. But the short call is now covered by a long call. What if we do the same? We short sell a put, I don't know, 270? No, now the price is 270. We short sell the call 275. We short sell the put 265, let's say it. Okay, so we short sell the put 265. Then we know that if we do that without any parachute, if we are very wrong and the price drops significantly, we could have a significant loss. Okay, so what if we purchase a put with a lower strike price in order to have a parachute on both sides of the strategy? Here we purchased a call $15 from the short call. Let's do the same for the short put. So let's do it once again. We do a new strategy made of a short call, 275 for 535. We add a long call, 290 for 155. Then we add a short put, 265 for, let's go see the price. The put 265 could be sold for 495. And we add a long put, $15 lower, 250. That could be purchased for 220. Okay, what comes out? It's called Iron Condor. Okay, this is called Iron Condor. We have a short strangle, short put 265, short call 275, hedged by one long put 250 and a long put 290 and the long call 290. Okay, so we have a short strangle combined with a long one, long put 260. Long put 250, long call 290. This is a long strangle with strike prices more distant from the current value of the underlying, combined to a short strangle on strike prices closer to the strike price. So a short strangle combined with a long strangle. But at the same time, a bear call vertical spread, short call 275, long call 290, combined with a bull put vertical spread, short put 265, combined with long put 250. So bull put vertical spread combined with bear call vertical spread. So two different ways to see the same strategy. An Iron Condor, a very popular strategy among option traders. And as you can see here, you have a maximum potential profit 655, a maximum potential loss 845. So we combined the statistics, because here we have 75%, more or less 75% of the odds to be at maturity. You remember the distribution of returns. In the central part of the distribution lays 75%, 72, 75, 78, 79% of the probabilities. But if you are wrong, if you are very wrong, and the price goes significantly up or significantly down, if you do not hedge yourself, you could have significant losses. But if you add to the strategy a long strangle, or you create the combination of two vertical spreads, and you put parachutes on both sides of the strategy, 70% of the time, 75% of the times you will gain, 25% of the time you will lose, but at most you know how much in advance. This is the Iron Condor. What if we started with a put and a call short sold on the same strike, with the short straddle, not with the short strangle? Let's do it. Let's combine the short straddle on the strike 275 combined with the long strangle on the strike prices 250 and 290. 290. Yes, let's do it. Create new strategy. This time we are combining a long put 250 for 220. A long call 290 for 155 plus a short call 270, sorry, the ATM. 270 is 795 for the call, 650 for the put. 795, 650. This is the call, 795. And this is the put, 650. Close the strategy. Here we go. Iron butterfly. This is called iron butterfly because with a bit of fantasy you could see this payoff as the shape of a butterfly. Okay, these are the wings, this is the body. In the body you have 70, in the belly, they say in the belly you have 75% of the odds, more or less. In the wings you have 25% of odds to lose. And as you can see, the maximum potential profit is even higher than the maximum potential loss. But with the iron butterfly, the maximum potential profit is concentrated in one single point at maturity, the same strike of the call and the put sold, short sold. So once again, this is a combination of a short straddle and a long strangle, or a bull put vertical spread and a bear call vertical spread, same as seen before for the iron condor. These are the two most popular strategies, the iron condor and the iron butterfly. But of course, you can change the distance between the strike you short sell and the strikes you purchase, and you can offset the distance between the short call and the long call and the short put and the long put. Let's see an example. Just to say, assume that you expect that the odds of a price increase are higher than those of a price decrease. According to the chart, you remember the price is trending up, so the most likely direction of the price could be the upside than the downside. So why not taking a reduced risk on the upside and decide to suffer, to accept a higher risk to the downside? How can we make it? We could offset the distances, take a closer distance for the parachute to the upside, and leaving the same distance as we are seeing here for the parachute to the downside. So $15 to the downside, and let's say, I don't know, only $5 to the upside. What happens? We will achieve an asymmetrical butterfly, also called broken wing. Let's say it. Create new strategy. We take the put short 270 for this price. We add a long put 15 strike. No, this was 20. Okay, it was 250, $20 to the downside, and it was $2.20. Then we add a short call 270 for, what was that, 795, yes. And we add a long call, let's say 275, only $5 distant, for 580. Okay, close the strategy. Here we go. This is a broken wing butterfly that has a very peculiar feature. It has no losses on the upside. And this could be much more coherent with the expectation that according to the current price trend, the odds for the price to keep going up are higher than to come down, to go down, to drop. Okay, so in this way we would have a significant gain if the price at maturity was very close to the current value, to the value in the beginning. If we are wrong to the upside, we will still keep a benefit, not as much as what happens in the central part of the strategy, but still a profit. No matter what happens, if the price goes up, we will gain in any case. If the price goes down, we will lose, but at most a prefixed maximum amount, $1,355. This is a typical broken wing butterfly. Could we do the same with the iron condor? Absolutely yes. Let's do this. Let's go back to the initial strategy. It was a short put, strike 207, 265, 65. Short sold for, I don't remember, the 265 for 495, the put. Covered with a long put, 250, purchased for 220. And then we had a short call, strike 275 for 535. And we had a long call with a shorter distance, not $15, but just 5, that we could purchase for $3.70. What happens? Close strategy. Here we go. A broken wing condor. This time we do not have a profit no matter what. But if we're wrong and the price goes up like a rocket, at most we will lose. Let me check it on the payoff data. To the upside, $60. That's the maximum potential loss on the upside. Okay. If we're wrong to the downside, we will have a much higher potential loss, but at most 1,060. This is what you can get combining different options, shorts and puts, short and long, with different strike prices, but with the same maturity. You can also combine options with different maturities, but here I cannot use this Excel spreadsheet because this macro can only manage one maturity at a time. If you combine options on different maturities, you get to horizontal spreads or diagonal spreads. And this kind of strategy is much more complicated. We have to form hypotheses about what could happen in the future, because there is not a payoff at maturity that you can draw for sure. You can only make hypotheses because when you combine an option expiring on January and another option expiring on March, just to say, what you will have to deal with is what will happen at the maturity of January. And in January, you will have an option expiring whose payoff will be certain, and an option with another 2 months of residual life whose payoff, who knows what could be. You will have to deal with the combination of a payoff at maturity and at now curve, and it is not absolutely easy. I have some examples in my presentation, so I apologize, but we have to go back to the presentation and see some more slides.